If you've been watching the news, you know that Toronto's real estate market has been volatile for the past 5 years. We're seeing sales plummet in some areas, while listings are piling up in others. In Toronto, the data is all over the map. We have the condo market taking a serious hit, while at the same time, the single family home market in certain pockets is actually performing well. It's confusing, it is stressful, and it leads to the one question: should I be buying a home this year? The answer I'm going to give you in this video might surprise you. It has very little to do with interest rates or what the news headlines are, and everything to do with your personal circumstances. In this video, I'm going to break down exactly why you should not buy a home in Toronto this year if you fall into specific categories. I want to save you from making a massive financial mistake, but stick around till the end because I'm also going to share exactly who should be buying right now and how to do it. There is so much noise out there. You have headlines screaming about crashes and others talking about recovery in certain areas. But here's the reality: deciding to buy a home should not be about timing the market perfectly. It's about understanding the risks. I'll walk you through the 5 major red flags. If any of these apply to you, walk away. You're not ready to buy in 2026. Red flag number 1: the short-term horizon. The first reason you absolutely should not be buying a home this year is if you are viewing it as a short-term move. If you're buying a property knowing that you're going to move again in less than 3 years, it is possibly a bad idea to buy. Whether it's an investment or a place to live, short-term ownership is very dangerous in this market for 2 reasons. First, short-term market fluctuations can eat up your down payment and equity very quickly if you are forced to sell during a dip. We saw prices drop significantly in 2022 and 2023. And if you needed to sell then, you were in trouble. Second, the transaction costs in Toronto are high. You have to factor in the mortgage penalties if you break your mortgage term early, which can eat into your equity. And then there are the selling costs, real estate commissions, legal fees, and moving fees above and beyond the purchase costs, such as double land transfer tax and legal fees. Now, if you aren't planning on owning that home for at least 7 to 8 years, the math works against you. If you have a definitive short timeline, do not buy. Renting gives you the flexibility you need without the risk. Red flag number 2, the FOMO trap. The second reason to stay on the sidelines is if you are suffering from FOMO, the fear of missing out. Over the last few years, especially during the peak, so many people got caught up in this. They bought a home simply because everybody else told them to do so, or they were terrified that if they didn't buy at that time, they'd never be able to. To be clear, you should never buy a home just because everyone else is doing. The people who lost the most money in the real estate market recently are the ones who weren't truly ready. Maybe they couldn't really afford it, but they jumped in because they thought the market only goes up. They bought at the top, and now they're stuck with properties worth nowhere near what they paid for at that time. Do not make financial decisions based on peer pressure or panic. Only buy when it is the right time for you, not just because there's activity in the market. Red flag number 3, betting on lower interest rates. Now, let's talk about the economy. The third reason to avoid buying is if your entire strategy relies on interest rates dropping lower. Some buyers might jump back into the market because they expect the Bank of Canada to further cut rates, and they think their monthly payments will be lower in the future. Here's the hard truth: don't get caught up in the idea that rates have to go lower. They don't. The Bank of Canada has cut 9 times since the peak of July 2023. Even if they cut further, they probably won't drop as low as you expect them to. If you buy a home at the limit of your budget, expecting cheaper payments next year, and the Bank of Canada surprises you, you are in trouble. Never base a 25-year mortgage decision on a 12-month interest rate prediction. The Bank of Canada insinuated they will be on the sidelines for a while, and at the same time, bond yields spiked to 3%, pushing fixed mortgage rates higher. The next determining factor is the North American free trade outcome upcoming this summer. Red flag number 4, bidding wars. The fourth red flag is about the environment you're buying in. If you're looking in a neighborhood where every single property has a bidding war, proceed with caution. Multiple offers on every listing is a sign that the market is heating up or potentially overheating. We saw this in 2021. People believed prices would never correct, and then they dropped by 20% in some areas. Now, if you're in a bidding war, set a realistic budget and price for the home. Do your due diligence upfront by completing a home inspection and confirming your numbers with your mortgage broker. It is prudent to have extra capital available in case the appraisal comes in lower. For example, let's say you bought a home for $1,050,000 and the appraisal came in at $1 million. The lender will finance up to 80% of the appraised value, and in this case, an $800,000 mortgage, which means your down payment has gone up from $200 to $250 plus closing costs. Red flag number 5, post-closing finance. The final reason not to buy is simple. You can't afford the worst case scenario. Never buy a property if you don't have a buffer. If rates go up, if you lose your job, or if we hit an unexpected recession, can you still make the mortgage payments? Too many buyers take every penny they have and dump it into the down payment. They forget about the hidden costs of homeownership, insurance, property taxes, emergency repairs, and utilities. And that's above and beyond buying food and groceries. You need to have at least 6 months worth of living expenses saved in cash after down payment and closing costs. If you're scraping the bottom of the barrel to get into the market, wait. Build your safety net first. Who should buy? I've given you all the reasons not to buy. Does that mean nobody should buy a home in Toronto in 2026? Absolutely not. People are buying every day, and for many of them, it's a great decision. So the question is, who should be buying? The answer is people whose life circumstances justify it. If you have lived in your home for many years and have a growing family needing more space, buy a home. If you have a new job with a long commute and you need to move closer, buy a home. If you're putting down your roots and plan to stay for 10 plus years, buy a home. Or maybe you just got into a serious relationship and you don't want to live in your old bachelor pads anymore. If you're tired of paying your landlord's mortgage and you have a solid down payment plus emergency funds, buy a home. The key is don't try to time the market. Don't try to outsmart interest rates. If your employment is secure and you're financially in a good position, buy a home. If the payment is comfortable for you and the home fits your life for the next decade or so, the market volatility doesn't matter. If you're looking for a strategy that fits your specific life situation, or if you want help finding a property that makes sense for the long term, feel free to reach out via the link below in the description. If this is your first time here, I help people navigate the Toronto real estate market. If you want the latest news and honest advice without the sales pitch, do me a favor. Hit the subscribe and like buttons so we can get this information out to more people. Thanks for watching, and I'll see you in the next video.